over half of Singaporeans do not have a retirement plan, and among those who do, 40% are not on track to meet their retirement goals. This is the harsh reality for many Singaporeans, a future where they will continue working past their retirement age, not because they want to, as PM Lawrence Wong mentioned, but because they have to, just to stay afloat financially. This is also the reason why we often see the elderly pushing trolleys, wiping tables, or manning cashier counters. In fact, nearly 50% of those aged 65 to 69 are still working, and a significant portion in their 70s continue to do so as well, often for very low wages ranging from a few $100s to a few $1,000s. Now, while it's true that some may choose to work to stay active or fill their time, many are simply doing it because they can't afford to retire. One survey by SMU found that nearly 1 in 3 older adults in Singapore believe that there was at least a 50% chance that they will struggle to afford basic necessities or pay their bills, while Asia One found that only 39% of retirees have enough funds to retire. Okay, before you be like, panic let's take a step back and ask ourselves a very important question. How much do we actually need in order to retire? Obviously, the amounts that you may need for retirement will vary from person to person. For example, if you are planning to just have a conservative retirement where you live in a HDB property, only take public transports, and go for occasional regional holidays, you will only need $1,600 a month. But if you want a super aspirational retirement where you live in a CB nice private property, drive a CB high-end car, have a helper, and go to CB atas places for vacation, then you will need at least $4,000 a month. Assuming you are 30 years old now, plan to retire at 63, and can live till 85 years old, with a 2.5% average inflation rate, you will need anywhere between $1 million to $3 million in order to retire. Quick pause. If you are someone looking for lower risk, stable returns, or simply want to diversify your investments, you might want to check out the Income Plus category on Moomoo SG. You have probably heard of Moomoo's Cash Plus before, but the main difference between Cash Plus and Income Plus is that the funds under Income Plus can potentially give higher returns. These funds primarily invest in bonds and certificates of deposit, assets that typically have low default risk and predictable returns. To check out Income Plus, just open the Moomoo app, tap on Discover, then Wealth, and scroll down till you see Income Plus. From there, you can tap on any fund to dive deeper into the details. New users who sign up to Moomoo SG get to earn up to 820 SGD worth of welcome rewards when you fulfill the terms and conditions. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. But wait, don't we have CPF Life to give us money income during our retirement? Yes, we do. But according to the latest CPF data, nearly 1 in 4 members aged 65 to 70 have less than the full retirement sum in their CPF account. This means that their CPF Life payouts will not be enough to even meet the basic standard of living. But even if you have set aside the full retirement sum, the monthly payout under the CPF Life standard plan is fixed for life, and it doesn't adjust for inflation. This means as the cost of living rises year after year, your payout stays the same, effectively eroding your purchasing power. For example, assuming you are living a very conservative retirement and you expect to only spend $1,600 a month prior to inflation, if you only have $100,000 in savings and have set aside the full retirement sum in your CPF, you will still run out of savings in your late 70s. Now, fortunately or unfortunately, we are all living longer. Back in the 1950s, the average life expectancy in Singapore was just 62 years. Today, it is 83.5 years. And by 2050, it is projected to reach 87. What this means is that retirement is no longer just a 10 or 15-year phase. For many, it could stretch to 20 or even 30 years, and that means our money needs to last much longer now. At the same time, given that Singapore is facing a rapidly aging population, by 2030, 1 in 4 will be aged 65 and above. As a result, there's a possibility that CPF Life monthly payouts may need to be adjusted downwards to maintain the sustainability of the scheme. This creates a double whammy, where we will need more savings to support a longer retirement, while potentially receiving lower payouts from CPF Life. This is also why the government is going to raise the retirement age to 64 in 2026, just so that Singaporeans can continue to work longer to fund their retirements. So then, Why do so many of us struggle to save money for retirement? One common answer is the high cost of living in Singapore. However, if we examine the real change in median monthly household income, or in other words, income growth adjusted for inflation, the trend has been generally positive. This means that on average, our incomes have been rising faster than inflation. So in theory, we should be able to keep up with the rising cost of living, right? If that's the case, then where exactly is all the money going? One of the biggest culprits is food, which is the second largest household expenditure after housing. Back in 2012 to 2013, spending on dining out, including restaurants, cafes, and pubs, made up about 35% of total household food expenses. By 2023, that share had ballooned to 42%. A major reason for this is the sharp increase in food services inflation. The cost of eating out, whether it's restaurants, fast food, or even hawker centers, has climbed significantly in recent years, with prices climbing 5.3% in 2022, 6.1% in 2023, and 3.6% in 2024. And that's just the average cost of dining out. If you look at individual food prices, the actual price jump can be a lot higher. For example, a plate of char kway teow, which used to cost just $3.80 back in 2019, cost $4.52 in 2023. That's an increase of 19%. Likewise, a McSpicy set back in 2008 cost just $6.40, but now it costs $8.30. That's an increase of close to 30%. Besides food inflation, more and more Singaporeans are also getting comfortable with the idea of spending money that they don't have. After the pandemic, credit card rollover balances jumped from $6 billion all the way to $8 billion. This is in conjunction with OCBC findings that around 1/3 of credit card holders often pay the minimum sum, and 18% who spend beyond their means to keep up with their peers. And for those who can't qualify for a credit card, they turn to buy now, pay later services, where it was found that 77% of Gen Zers in Singapore used buy now, pay later. Now, to be fair, the government has been taking steps to address the rising cost of living, particularly for the lower income households. In 2023, households in the bottom 20th percentile received an average of $10,000 per household member through various government transfers. That's equivalent to 47.8% of their annual income, which is a substantial amount of support. But let's be honest, you can't just survive on YouSave rebates and CDC vouchers alone. Thankfully, it's still not too late to plan for retirement, assuming you have not retired yet. So here are a few practical steps to get started. First, find out how much you actually need for your retirement. There are plenty of tools available to help you estimate this. For example, the DBS NAV Planner or the OCBC Financial One View can give you a clear snapshot of your current finances, including your CPF savings, insurance, and investments, all in one place. And with that, you can start to project how much more you will need to reach your retirement goals. Otherwise, if you are scared of letting the bank know how much you have, I've also created a retirement calculator, which you can download for free. With this, you can easily project how much you need to save up for retirement and whether you are on track or not. Second, one of the great things about Singapore is that there's a wide range of government schemes specifically designed to help you grow your retirement savings. Therefore, it's important to take full advantage of these opportunities whenever possible. For example, under the CPF Retirement Sum Topping Up Scheme, you can top up your CPF SA, RA, or MA every year to boost your retirement nest egg, while earning 4 to 6% interest, and enjoying up to $8,000 in personal income tax relief every year. And if you are aged 55 to 70 and have less than the basic retirement sum in your CPF, the government will also match every dollar that you top up to $2,000 a year. Essentially, free money added to your retirement savings. At the same time, you can also contribute to your supplementary retirement scheme account. Contributions are eligible for tax relief, and you have the flexibility to invest the funds in a variety of instruments such as stocks, ETFs, and more, helping your savings grow over time. Beyond CPF and SRS, you could also explore schemes like the Lease Buyback Scheme or the Silver Housing Bonus Scheme, which can help you unlock the value of your property to support your retirement needs. Finally, you need to start investing your money. Without investing, your savings will slowly lose value to inflation year after year. Let's be honest, simply parking your money in a high-interest savings account or a government bond earning 2 to 3% interest isn't going to be enough. At best, you are just keeping pace with inflation and not growing your wealth. To build a retirement fund that truly lasts, your money needs to work harder. And that's where investing comes in. One of the simplest and most effective ways to begin is by investing in a low-cost, broad-based ETF. These funds spread your investment across a wide range of companies, thereby helping you to reduce risk while capturing the overall market's growth. Plus, you can easily set up a regular savings plan to automatically dollar cost average into these investments. This means you invest a fixed amount regularly, smoothing out market fluctuations and letting your money grow steadily over time, all without the stress of constantly monitoring the market. In short, even though our retirement may seem far away, it's never too early nor too late to start planning for it. The sooner you take control of your finances, the better you'll be prepared to enjoy a comfortable and worry-free retirement. Remember, small consistent steps today can make a huge difference in your financial future. So start now, use the tools and schemes available, invest wisely, and let time work in your favor. Your future self will thank you for it. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.